Scroll through any social media feed today, and you will see a world bathed in endless luxury. Sports cars, designer clothes, five-star holidays. From the outside, it looks like everyone is living a life of extreme wealth. Look at this chart. On the left, the towering height of perceived wealth. On the right, the net worth of the average consumer. Most people flashing luxury items are drowning in debt, sitting deep in the red just to keep up appearances. We've fallen into a very specific psychological trap. As a society, we have confused the act of spending money with the reality of actually having money. Because of this confusion, we tell ourselves myths about how wealth is built. We assume it requires a massive six-figure salary, a risky crypto gamble, or a multi-level marketing scheme. The truth is entirely different. The actual playbook for becoming a millionaire is shockingly simple, deeply unsexy, and built entirely on boring rules that most people actively ignore. Achieving actual financial freedom means completely opting out of the performative wealth trap. You have to embrace a countercultural approach to how you handle your cash. Let's start with how you handle credit. Inside the banking industry, there is a specific insider term for a customer who pays off their entire credit card balance every single month. They call them deadbeats. Credit card companies absolutely hate deadbeats. By refusing to carry a balance month to month, these highly responsible spenders generate zero interest profit for the banks. They get all the convenience of the card, and the bank gets nothing in return. The bank's ideal target demographic is the exact opposite. They want the consumer who normalizes bad debt. The person willing to finance depreciating assets like designer shoes, new phones, and expensive holidays, paying a massive premium for the privilege. This line graph illustrates the math perfectly. That steep decline is the value of a financed luxury vehicle plunging the second it drives off the lot, dragging your net worth down with high monthly payments. That shallow, stable line, a reliable used economy car. A luxury car is a money pit. A reliable Toyota Corolla does the exact same job as a BMW without the financial drag. The modern rule of status is simple. Having absolutely zero car payments is the ultimate financial flex. You might think the best way to buy that freedom is to make more money, but mathematically, cutting unnecessary spending is far more effective for building wealth than constantly chasing a higher salary. To cut that spending, you need an honest baseline. The foundational rule of budgeting is to track every single outgoing expense for 30 days. Don't change any of your habits during this time. Just observe where the cash actually goes. What most people discover during this exercise is a trap called lifestyle inflation. This happens when your baseline spending immediately creeps up to consume every new raise or promotion you receive. You make more, so you spend more, and your net worth stays perfectly flat. This equation visualizes the defensive strategy you need to fight it. Deliberately overestimate your monthly expenses and underestimate your incoming salary. By rounding bills up and paychecks down, you force a built-in safety margin into your finances. A high salary is completely useless if the cash leaves your account exactly as fast as it enters. Defensive cash flow management is the only mechanism that actually retains wealth. Once you retain that wealth, you have to grow it. And here, we must distinguish between diversified long-term investing, which relies on math, and short-term gambling, which guarantees losses over time. Before you start chasing market returns, you have to optimize your risk. Do not buy a single stock until you have a fully funded emergency fund, health insurance, and life insurance. Secure the floor before you build the ceiling. Once you're secure, follow the 85-15 rule. This pie chart breaks it down. Aim to spend 85% or less of your total income on your life and strictly reserve the remaining 15% for your investments. That reserved fraction is where the math of compound interest takes over. When placed in broad, low-cost index funds, which track the performance of the entire market, that small percentage multiplies exponentially across decades. The secret to ensuring this growth happens is to automate the entire process. Pay yourself first. Treat that investment transfer like a non-negotiable monthly bill that gets paid the second your paycheck clears. Wealth isn't generated by obsessing over a mutual fund that yields 1% more or finding the perfect secret stock. It comes from giving a systematic, automated process enough time to do the heavy lifting. Now, a quick point of nuance. Not all debt is toxic. Taking out a mortgage to buy an appreciating asset like a house, or taking on a student loan to increase your earning potential are valid tools of leverage in the modern economy. But outside of those specific exceptions, the overarching consumer rule remains absolute. If you cannot afford to pay for something in cash right now, you definitely cannot afford it with installment payments. When you strip away the social media filters, the reality of wealth is highly accessible. Becoming a millionaire does not require genius intellect. It simply requires immense financial discipline and the stubborn passage of time. The required shift happens in your mind. You have to respect money for the security and options it provides, rather than worshiping it for the external status it buys. Mastering these boring, basic rules delivers the ultimate prize. You get to opt out of the stressful, never-ending race to look rich, and you earn the quiet, lasting freedom of actually being rich.